Hello, good afternoon, everybody. My name is Seth Colby. I am one of the board members of the Hawaii Economics Association. We're going to begin our webinar in 1 minute, so please hold on while we're letting people sign in. Thank you. Good afternoon, everybody. Welcome to the Hawaii Economics Association's webinar on understanding Hawaii's condo insurance market. My name is Seth Colby. I will be moderating the event. I am also one of the board members of HEA. If this is your first time to an HEA event, we are an organization that provides a venue to investigate pressing issues facing the state using the lens of economics. So if you like what you see, we really encourage you to become a member and participate in more of a programming going forward. And if you have great ideas on topics or issues that you would like to see discussed at HEA, we always welcome your ideas. So please send us a note on that as well. And before I begin, I would like to thank today's sponsor, the Hawaii Realtors Association. These types of events would not be possible without the generous support of our sponsors. So with that, today we're going to try to understand the turbulence that's occurring in Hawaii's insurance market, right? I think if you're on the call, you're aware that it is an issue. Most of us have read things in the press about condo fees going up, insurance premiums, something to do with hurricane insurance, something to do with the Hawaii Maui fires. Maybe it's related, maybe it's not. Today we're gonna clear all that up. So by the end of the presentation, and with the help of 3 outstanding panelists, we are going to make sense of the insurance and what's going on in Hawaii's insurance industry, understand why it's important and how it's relating each one of us, and possible remedies and solutions for the current turbulence and turmoil. So before I introduce our panelists, I wanted to just provide a brief personal anecdote, because I think it is exemplary, or it's emblematic of what's going on in the insurance market. So 7 years ago, I bought a condo in Kaka'ako. And this isn't one of the blingy Howard Hughes condos. I'm a state employee, and I couldn't afford that, right? So I bought into one of the, traditional concrete buildings. And one of the things I was really looking forward to is one without amenities, because I wanted to keep my HOA fees low, right? And so it did have low HOA fees when I bought into the building. But over the last 7 years, my HOA fees have more than doubled. Now, I'm your typical renter, or your typical owner, right? So every year I would get a letter saying, oh, the HOAs are going up by 7-8%. And I would hold up this letter and I would curse it to the sky and curse all the board members and say, oh, those security staff, we're giving them too much money. Oh, this is terrible. Why are they raising my HOA fees? And then I would go dig into the financials of the whole situation. And 2 things that really stood out. One is we pay most of our money goes to 2 things. One is insurance, right? So in Kaka'ako, in my particular building, we're within a FEMA flood zone. And that really increases the cost of our flood insurance and our hurricane insurance. And the second thing that I saw was our reserve fund, right? And so when I first bought into the building, we had a reserve fund of a couple $1 million. And I thought that was substantial, right? But we had one elevator project. Now, one elevator project doesn't sound much, but it was a $2 or $3 million project. And that's how much it costs in Hawaii. And it wiped out our reserves, and so we had to increase again. Now, every time that the HOA goes up, I put political pressure on my board members to not have it go up. I don't go to the board member meetings because I'm a typical condo owner, right? But as you can see, it's creating these dynamics where I don't where we don't want to raise our HOA fees. And I am lucky because I'm a state employee. I can afford increases to my HOA fees, but many of my neighbors are low-income or people in pensions, and they're not used to, they can't afford, they have a fixed budget, right? So it's much harder for them to absorb large increases in their HOA. But you see this dynamic. You see, oh, we want to have minimum increases. On the other hand, what's really happening within the in our building is costs are going up, right? Our maintenance fees, we have to do important maintenance projects, and that actually keeps the overall long-term costs going down. And our insurance fees are going up. So this is what's known as a collective action problem in economics, right? If I was a homeowner, I would own up to all of these things a lot easier. But since I am a condo owner and one part of a larger group, my tendency is to shirk my responsibility, or like I just don't feel the direct effects as much, right? And I see the direct benefits less from what I'm contributing. And so you can see why there's this political dynamic to resist increases in condo fees and not really participate in the process, while at the same time, important risks are building within a project that I own. And it is the largest financial asset that I have, right? So in today's in today's webinar, we're going to discuss why my insurance premiums are going up, right? And we've also heard through the press that that insurers are leaving the market, and we're going to understand why they are leaving, right? These are facts that are happening, and it's something that the state is going to have to adjust to and accommodate. So in order to do that, we have 3 outstanding panelists, and each one of us are going to answer a separate question, a separate aspect of these questions, of these issues. The first one is, so what is happening in the insurance market, right? So we have Mike Onofrieri representing the Hawaii Insurance Council, and he's going to explain to us the dynamics of the insurance. Second is we have, what are the implications for a changing insurance market on our financial, on our assets, right? On mortgages, things like this. And to speak to this, we have Victor Brock representing the Mortgage Bankers Association. And then finally, so what can we do about it, right? The government has been, the legislature has been active in investigating things they do that, things to ameliorate and at least reduce the amount of turmoil and uncertainty in this market, and so they can support condo owners. And to that, we have House Speaker Scott Saiki, who has been leading the charge on this issue in the legislature. And more than that, he's a representative in Kaka'ako and Ala Moana, right? So many of his constituencies are feeling this directly. So today's format is going to be the following. We're going to have a short presentation by each one of our panelists, about 8 to 10 minutes. And then they're going to go in direct succession. Then I'm going to stimulate a moderated discussion between the 3 panelists to really investigate and probe different aspects of what they said and the dynamics of the market. Afterwards, we will open up to question and answer. In order to, let me show you our wonderful panelists and their bios. You can see them right there. In order to ask a question, just go down and use the Q&A button. I encourage you to do that now. And some people will upvote or upvote certain questions. We're probably not going to get to all the questions today because we only have about an hour to tackle this huge topic. So please get your questions in as soon as possible, and we'll address them as much as we can. So without further ado, I'm going to invite Mike to give a presentation on the insurance market. Thanks, Mike. I really appreciate this.
Okay, hopefully folks can see my screen.
Yes.
Okay. Well, thanks, Seth, and thank you, everybody, for attending. I'm Mike Onofrieri. I'm an actuary, and Seth asked me to start out by just doing a kind of a quick overview of exactly what insurance is. effectively, it's a promise to pay in the event something bad happens, a covered loss. Your policy provides what the coverage is in exchange for paying the premiums. And the idea is we remove an element of uncertainty about something bad happening and replace it with some level of certainty in exchange for premiums. And the risks are spread against all similar insured customers. That's why even sometimes if you've got a never had a traffic accident in your life, never had any issues, your premiums can still go up because you're part of a giant pool of some people who've had many traffic accidents. So it's a unique product. The true cost of the policy is unknown when we issue it. We use past experience, prospective trends, wind models, and other tools to develop the premiums, but the actual experience may not be known for many years for some coverages. For example, my company had a workers' comp claim that opened in 1962 and settled in 2014 when the claimant passed away. So there are incentives in insurance. And generally, insurance incentivizes responsibility. So drivers that don't have at-fault traffic accidents pay lower auto insurance premiums than those that do. And these are oversimplifications. This is sort of all else being equal. Businesses that have effective employee safety programs pay lower workers' comp premiums than those that don't. Condo buildings with updated plumbing systems and sound reserves typically pay less than those that don't. And I know right now, the ocean is rising. All condo buildings are paying a lot more. So sometimes the risk inherent in insuring an individual, a business, or a building is so great that insurers are unable to develop an adequate price. And that's been happening for many older condominium buildings over the last few years. They become uninsurable at the rates that Hawaii licensed insurers are able to charge. So what's happening? So let's first look at our condo unit inventory. Over 70% of our units are over 35 years old. Or about 30, yeah, 1989, 35 years old. That's pretty old stock of buildings. And in those 35 years, and you can see we have condos built back before 1950, a lot of things can happen, including damage to pipes, which we'll talk about in a minute. So let's talk about some market constraints. We're a small market. There are only 3 Hawaii licensed insurers that have been writing the majority of condo buildings for many years. Other property insurers, both locally or mainland companies or international companies, have been unwilling to enter the market to write condo buildings. There's been increasing losses, and we're going to talk about those in a minute, and reinsurance capacity constraints that make the market of Hawaii even more attractive for new entrants. Reinsurance is something that insurance companies buy to protect their portfolios. If it weren't for reinsurance, a number of insurance companies in Hawaii would have gone out of business as a result of the Lahaina fires. If there weren't reinsurance in 1992, even more insurers than the one that failed would have gone bankrupt. Again, reinsurance serves as a foundation for the industry. So as losses mounted, one of those 3 insurers began reducing their exposure. Exposure is a nice way of saying the buildings that they write. So the non-Hawaii licensed insurers have picked up the slack, but they charge multiples of what the prior premiums were. And I think that's the sticker shock many are facing now. So the non-hurricane coverage issues have been kind of bubbling up since really 2021, and we began having a dialogue with policymakers and others in 2022. Rates were increasing for condo buildings and the unit owners insurance, and the increases were due to significant increases in frequency and severity of water damage claims. Marco Polo, the Surfside collapse in Miami, also contributed to the concern about high-rise buildings in particular and condominiums and townhomes in general. Then we talk about hurricane coverage. So one insurer now includes a lower limit of hurricane coverage compared to the building value. So for example, if the building's value is $100 million, this insurer is only willing to write $10 million of coverage. So buying additional hurricane coverage is very expensive, and typically it's only available for non-licensed or from non-Hawaii licensed insurers. Sometimes they're called surplus lines. If you're on an AOAO board, you may have heard that phrase that your agent says you can only get coverage from the surplus lines market. Now, hurricane coverage is supported by reinsurance, which has been getting much more expensive over the last several years. Lahaina didn't help. And really, the thing behind this is climate change. Reinsurance is worldwide. Events that happen in Europe or in Asia or in Kansas or in Florida all impact the cost of reinsurance that insurers pay regardless of where they write business. Uh, Insurance or reinsurance premiums have been increasing pretty dramatically in most markets. Hawaii's reinsurance premiums were not as bad as other places, certainly not as bad as Florida's, but that was until Lahaina. The reinsurance renewals companies, including my own, have experienced are much more significant than they were in prior periods. And that's fueling the problem with hurricane coverage. Essentially, with hurricane reinsurance, you have a certain amount of capacity. The reinsurer will say, okay, company X, we will give you $1 billion of capacity to use. So if you're the insurance company, you have to deploy that in the way that makes the most economic sense. Wish I had more time to discuss reinsurance, but it's again an important part of what the insurance industry uses to protect itself and thereby consumers. So want to talk briefly about unit owner's premium. So if you own a condo, as Seth does, you have a unit. Not only are you paying for the building insurance through your maintenance fee, but you're probably buying unit owner's coverage to protect your belongings, maybe your custom cabinetry or other things in your unit. So Hawaii, this red bar here, has been paying about the average in unit owner's premium, and this is as of 2021, based on information from the National Association of Insurance Commissioners. The markets that are circled over here are Florida, Louisiana, Texas, Alabama, and Oklahoma. What they kind of have in common is they're exposed to significant catastrophic losses, particularly wind losses. Now, in Florida and Louisiana, it's hurricane and some cases tropical storm. Same with Texas, but Texas also has a lot of tornado activity as well, as does Oklahoma. Hawaii condo premiums have been going up, or unit owners premiums, and they're going to be going up significantly more over the next few years. So I'm going to talk a little bit about markets of last resort, and that this will tee up Speaker Psyche when his turn comes. So most states have entities created by statute, and they're called markets of last resort, so that when coverage is unavailable, there's something in place so that commerce can continue to progress. Hawaii has two. One is the Hawaii Property Insurance Association. It was created in 1991, specifically for lava zones 1 and 2 on the Big Island. There was a massive lava flow beginning in 1983 that wiped out the Royal Garden subdivision, and insurers decided it wasn't a risk they were willing to undertake. So the HPIA was established to provide protection, or really so that realtors could close transactions, mortgages could be placed specifically for those lava zones. In addition, after Hurricane Iniki, the Hawaii Hurricane Relief Fund was created, and it was designed specifically to provide residential and small business hurricane coverage after Hurricane Iniki. It served its purpose very well. It really started writing policies in 1994, and by around 2003 or 2004, it went dormant because the private market came back. And the private market came back because reinsurance capacity became available again for Hawaii, and insurers felt like they could charge an adequate premium for that risk. So neither HPIA nor HHRF are authorized to insure condo buildings. And again, HHRF has been dormant. It's still on the books. It still exists in statute, but it hasn't written policies in many years. So markets of last resorts help by ensuring that coverage is available during different insurance markets. Not affordable. They try to make sure it's available. But when managed properly, they can offer prices less than charged by non-Hawaii licensed insurers. The intent is to stabilize the market while buildings get repaired and hurricane insurance and reinsurance capacity becomes more available. And that's it.
Thank you so much, Mike. That was really informative. Let's go straight on to Victor's presentation and we'll have the discussion afterwards. Victor, please go ahead.
Thanks, Seth. Let me try to share my screen here.
Oh, there we go. Thank you.
Okay, Mary, can you confirm you can see the full-size presentation, please?
Yes.
Okay, thank you for confirming. So, Seth, I appreciate your introduction and preamble about how you were frustrated with paying increased maintenance fees for your condo project over the years, because I'm going to tie into what you said. And Mike, I appreciate you doing such a thorough job explaining the situation with the insurance, particularly hurricane insurance and water loss issues. So I'm going to give you the lender's perspective. I work at a credit union. I've been in the mortgage business for 35 years. I've looked at literally hundreds of reserve studies and budgets for condo projects over the years. I also sit on loan committee currently, and in loan committee, we make decisions on condo loans to associations to do improvements, piping projects, and I can give you perspective on what we're seeing right now with those types of requests. So I'll give you kind of the effect on lending and affordability and housing of what is happening right now. So as Mike already mentioned, the hurricane insurance is getting more and more difficult to secure, and it really has nothing to do with the condition of the building. It's just random luck. Particular buildings have a particular insurer who is pulling back, and it may be that they maintain the building well or don't maintain the building well. So that's one situation that's happening. So if the building does not pursue what Mike referred to as surplus line carriers to get 100% hurricane insurance coverage, so is that situation is it caused by climate change? The fact that the hurricane insurance is drying up, you could debate that one way or the other. But I will tell you, it creates complications for financing on the mortgage lending side. So Fannie Mae, I pasted this directly from Fannie Mae's selling guide. It says that one of the perils that must be covered by any condo project includes named storms. So 100% coverage of the value of the building must be covered for named storms. Freddie Mac's guide is similar. So what's happening in the mortgage lending space is that any building who does not have 100% hurricane insurance coverage is going to have a difficult time for their individual unit owners to secure financing, or a potential buyer in the unit to secure financing. So Fannie Mae, Freddie Mac, FHA, VA, those are the types of programs that have the lowest interest rates with the low down payment options for buyers. Those options have disappeared in those buildings. So other options for mortgages other than the Fannie Mae and Freddie Mac. So mortgage brokers and independent mortgage banks, they have to sell everything to Fannie Mae, Freddie Mac, or other investors. So they can't finance those units. Portfolio lenders, typically depositories either here in Hawaii or on the mainland, may have options to retain these loans in their portfolios. And they may decide that they want to, or they're willing to finance units in these buildings with a shortage of hurricane insurance, but they may say no. Or if they are willing, they might say minimum 20% down payment because we cannot get mortgage insurance companies to participate in this loan and protect us. Also, the interest rates may be higher. They're typically higher, and they may limit the number of units in any building that they are willing to lend on. So there's pressures on those lenders to not make crazy decisions and make loans and a whole bunch of loans in a building that does not have sufficient hurricane coverage for safety and soundness reasons by their regulators. They may have too many units already secured in that building. And then there might be the concern that it's not just about insurance, it's really about what if there is a hurricane that hits Hawaii and there's a whole bunch of damage and losses to these buildings. So I would refer you all to go to YouTube and search Acapulco hurricane and see what happened just about 6 months ago when a Category 5 storm came through Acapulco, and how bad the damage to high-rise condos, that some of them look like they're concrete to me, but it's pretty devastating, some of the damage that they had. So go to YouTube. I have some slides at the end. If we have time, I can show those at the end. So lack of mortgage financing is drying up. So if someone wants to sell their unit, their pool of eligible buyers shrinks because those first-time home buyers with small amounts of down payment can't get financing. And then they might have to look for all cash purchasers, people that don't need to get a mortgage at all. And so these units may sell below typical market prices. And the prices, if this trend continues and these buildings don't have 100% hurricane insurance coverage, then you're sending a trend of lower prices in that building, and the values in that building may be permanently impaired. Also, anyone who wants to refinance for whatever reason in a building, they already own a unit, they want to refinance, they may have a difficult time. And if they can find financing mortgage, then they are going to pay higher rates. And anybody who wants to tap into their equity for whatever reason, they may have a difficult time finding a lender who's willing to give them home equity financing. So that's on the mortgage side. On the commercial side, I will tell you, I am not aware of any lender in town who is willing to make loan to the association to do their piping projects or other capital improvements if that condo project does not have 100% hurricane insurance coverage. There may be lenders out there or lenders on the mainland who are ignorant to the situation, but no local lender that I'm aware of is willing to lend when they don't have this hurricane insurance. So that's situation number one with the hurricane. Situation number two is we have deferred maintenance leads to insurance problems. Mike already described this. It's mostly due to water claims, deferred plumbing maintenance. So what's going on, as he mentioned, insurance are not renewing for the previous premiums or the previous deductibles, or they're canceling coverage altogether. So the association has to renew at substantially higher deductibles to make the insurance more affordable, or they have to renew at substantially higher premiums and or reduce their overall coverage to not 100% of the value of the building. So what's the rationale? And Seth mentioned, what is the core cause? And Seth mentioned, when he bought his building into his unit, he thought $2 million was sufficient reserve. So as I mentioned, I've seen hundreds of budgets and reserve studies for condo projects over the years. And I'm not going to get into the details about how a reserve study is done, but it's projecting forward and saying, here's how much you're going to need to do your capital improvements. And I will tell you, in all of them that I've seen, I think only 2 times have I seen a condo project that is 100% funded for their reserves. So almost every project has insufficient reserves. There's resistance to building reserves because it's already expensive in Hawaii. Your maintenance fees add to that expense. It's a high cost of housing in Hawaii. There's a general unwillingness to increase homeowners association dues by the board members because they live in the building and they've got to pay that increase. And it might be unaffordable for some people, particularly seniors who are on fixed incomes. Sometimes board members represent, well, if you elect me, I will never increase your maintenance fee. They're ignoring the fact that they need to build this reserve. And it's kind of a popularity contest to stay on the board. Oh, I didn't raise your fees. keep voting for me. And it's a mentality of, instead of dealing with reserving now for our capital improvements, we'll just kick the can down the road. So that's kind of setting the stage. So when they do increase their deductibles, so they have a lot of wiggle room there. Fannie Mae, Freddie Mac allows up to 5% of the insurable value to be the deductible, and that's not going to create a problem. For mortgage lending, so you got, for example, a $100 million building. To rebuild the building, you can have a $5 million deductible. That's ridiculous. Nobody wants a $5 million deductible. But what's happening is typically the $20,000 or $25,000 deductible is going up to $100,000. I've even seen one with $200,000. And so what the condo board is saying, we'll increase our deductible on our master policy, and then we're going to push it down to the individual unit owners to get what Mike referred to as the unit owner coverage. It's in the insurance industry known as HO6, to cover the full amount of the deductible. And so that $464 average that is paid by unit owners in Hawaii is going to go up, because now they're going to have to get more coverage to cover the full amount of the master policy deductible. So that's going to be an upward pressure on the individual unit owners' costs. One other thing to remember, and a trend that we're seeing, is some of the associations are saying, okay, we can't afford to insure the full insurable value or replacement cost of the building to rebuild the whole building, so we'll take less to make the insurance more affordable so that we don't have to increase maintenance fees to our unit owners. Here are screenshots of 4 policies that have come through our organization at the credit union and our servicing department. You can see the first 3, they only insured for $10 million, even though the building cost, the first one is $46 million to rebuild, the second one $57 million, the third one $108 million, and the fourth one they only insured for $20 million when it costs $131 million to rebuild. So when a condo association makes a decision to do this kind of thing, they're completely shutting down mortgage lending altogether on their building if they don't have hazard insurance. This is not hurricane. This is hazard insurance that I'm showing you. And then also on the commercial lending side, it will completely impair the ability for that association to get any kind of financing to do their capital improvements. So I'm going to diagram for you kind of what circular feedback we've got going on. We already have high housing costs in the state of Hawaii, and resistance to fund that reserve account to do capital improvements on that building in the long run. And so that leads to insufficient reserves and deferred maintenance on the condo building. And then you end up with deferred maintenance, particularly pipes. You get excessive claims. And then what happens is the insurer is saying, we're not going to keep paying all these claims, or they're going to cancel your insurance, or we're going to severely increase your premiums. And then you have the hurricane insurance problem added to that, where if they want to get full coverage, they have to go into the surplus line carriers. It's much more expensive for that. That's adding to insurance costs skyrocketing. So finally, the boards of these condos get to the point where they say, we can't keep paying this. It's ridiculous, the increases. And I can give you specific examples, but they finally get to the point where we need to lower our insurance costs. The only way we're going to do this is by fixing this deferred maintenance, so we don't have all these water claims. So they want to actually do the repairs, but then they look and they have insufficient reserves. So they say, okay, well, we need to finance these repairs. So then they go to a lender, and the lender says, the only way we're going to make a loan to the association is if you have full insurance coverage. So the board goes back and they get the full insurance coverage for hurricane and for hazard, and the costs are very high to the condo project. And so sometimes, even with that added insurance costs and the loan payment, they are able to get a loan made to the association directly. But what they do is they end up increasing the maintenance fee to the individual unit owners, and that's circles back and increases the cost of housing in the state of Hawaii. But sometimes, with the cost of the insurance being so high and with the loan payment being added in, that when the lender evaluates, can this association pay back that loan with those insurance costs and the loan payment, they say we don't feel comfortable that they can qualify for this loan. So a specific example that recently came across our credit union was the maintenance fees would have to go from around $650 per month per unit, with the loan payment in the insurance costs, 100% insurance coverage, the maintenance fees would go up to $2,000 more or less per unit. So going from $650 to $2,000 per unit per month, we did not feel comfortable that that was sustainable for that condo project, and we denied that request to that condo project for financing. And I think every other lender is going to do the same thing. So the only hope that the condo has is to go ahead and do a lump sum special assessment to every unit owner to pay for those improvements. But some unit owners cannot afford that lump sum special assessment. They can't qualify for their own loan, and it might be, and they don't have the money sitting in a kitty somewhere, which may end up eventually, and I haven't heard of cases happening yet, that they end up losing their home or they have to sell. If they can secure their own individual financing, that additional payment for their individual loan basically increases their cost of housing. And all of this filters down to rental prices. So I have a rental unit. I'm an individual condo owner in a high-rise in downtown Honolulu. My costs have gone up substantially in the last 2 years since I bought that condo, and I'm going to pass some of those costs on to my renter. So the theme here is that this whole insurance problem is increasing the cost of housing in the state of Hawaii and rent. And Civil Beat just posted an article that came through this morning to reinforce what I'm telling you in case you were not aware. That is the end of my presentation. I'm going to hand it back to Seth.
All right, speaker, why don't you go ahead?
Okay, thanks. Thanks, Seth. Thank you for the invitation today. Thank you to everyone for joining this webinar. So, I represent the Kakako district, and I live in a high rise. I am not an insurance expert, unlike Seth, who studied what was happening in his building. A couple of years ago, I kind of first started to hear about insurance when I saw notices in our elevator informing residents that we needed to increase our HO6 coverage. And I didn't really know what the reason was or why that was happening. So fast forward to November 2023, just a few months ago, when people from the different industries started to call me and to explain what was happening with the property insurance market. And they asked if there was any way for the legislature to provide some assistance. So what we did was we formed a working group with several people and organizations involved. Senator Jarek Keokalole, the chair of the Senate Consumer Protection, was a part of this group, along with the Mortgage Bankers Association, the Credit Union League, the Hawaii Association of Realtors, the Hawaii Insurance Council, and the Insurance Commissioner. So we worked for a couple of months to draft legislation, and this resulted in House Bill 2686. The goal of this legislation was to help stabilize the property insurance market by providing temporary stopgap coverage, property insurance coverage for uninsured condo buildings. So these were the main components of HB 2686. The basic concept was to expand coverage under the HHRF and HPIA for condo buildings. We proposed to seed $20 million to fund HHRF and HPIA so that they could purchase reinsurance and make that available to underinsured condo buildings. So again, as as Mike mentioned earlier, HHRF provides hurricane coverage and HPIA provides non-hurricane coverage, which basically falls into the categories of wildfire coverage and water leak coverage. So under our bill, the HHRF and the HPIA would manage these insurance programs. They both have boards attached to them. The boards would be responsible for purchasing reinsurance, selling policies, and collecting premiums to from condo associations. There was a proposal to limit policies to 5 years. The other concept behind this legislation was to provide coverage for condo buildings, as was mentioned earlier, as a last resort. And the rationale there was that condo buildings we wanted to provide assistance to buildings that had really made an effort, had been very diligent, but even despite their efforts, were unable to secure insurance or adequate insurance. So this was set up as a plan of last resort. Condos would apply for coverage, but they would have to show that they had made good efforts to seek insurance coverage elsewhere. They had good financials, they had good repair and maintenance plans, they had good reserve studies. So unfortunately, House Bill 2686 did not survive in our session. Our session ended on May 3rd. Unfortunately, there were some in the Senate who wanted to study this issue. So the bill did die. But I spoke with the governor about a week ago, and he told me that he wanted to keep this issue on the radar screen. He's planning to form a task force to continue to monitor this issue, to assess whether any administrative actions can be taken to address this over the summer, and then to draft or consider legislation for the next regular session in 2025. So this is an issue that the governor is aware of. It is on his radar screen, and he knows that it's really important that we continue to monitor it. So I wanted to also mention that, related to our legislation, that it is important for condo buildings, condo associations, to make sure going forward that their buildings are insurable. And they need to do this by making sure that their buildings are in good repair, and that they mitigate risks and claims within their buildings. This is going to require extra effort on the part of associations, the condo associations, as well as unit owners. Condo boards and the management companies are going to have to really understand what is happening here and what the condo associations and their management companies can do to prevent losses in the future. It's also going to be important for condo owners, the unit owners, to understand what they need to do within their own units to make sure that they mitigate or avoid water leaks and other kinds of losses within their units that may affect other units below them. So I didn't want to sound like this is negative about this whole issue. There is a positive side to this as well, because the legislature did approve a bill, House Bill 2801. This is called the CPACE bill. And the purpose of this bill is to assist condo buildings by making them insurable. This bill will basically provides a financing program for condo buildings to pay for their repair and maintenance. The concept behind this bill is to allow condo associations to secure a private loan. The loan would be repaid over time. It would be amortized through an assessment on each of the unit owners' real property tax bills. So because the unit owners are paying for this to repay the loan, the loan will follow the unit owner. So if a unit owner sells their unit and moves, then the new owner would assume the responsibility for that payment. So these are the types of capital improvements that would be eligible under the CPACE program. This is a tentative list. It would include water pipes, spalling, fire sprinklers, and energy efficient measures, so such as lighting, air conditioning, plumbing. The potential benefits of CPACE are pretty significant for condo buildings. By securing this loan, buildings will not have to assess front-end assessments on unit owners. So you'd avoid the front-end assessments. Instead, you would amortize the payments over time on individual unit owners. And as I mentioned, the unit owners would pay the obligation on a monthly basis through their real property tax bills. So House Bill 2801 was approved by the legislature. The governor is set to sign it into law in a couple of weeks. We currently have an administrator at the Department of Business and Economic Development who is working on implementing this program. The tentative start date is July 1st, 2024. So this office is working on the application process and all of the other specifics behind this program. This is Gwen Yamamoto Lau. She works with the Hawaii Green Infrastructure Authority. This is her website. If you are interested in learning more about this program, then please go to gems.hawaii.gov. As I mentioned, this program is tentatively set to begin on July 1st, 2024. And I know that Gwen's office is already receiving phone calls from condo buildings, but it's going to be really important, I think, for condo buildings to know that, associations to know about this program so that they can take advantage of the benefits of this financing program. Okay, that's everything I have. Thank you.
Thank you so much, Speaker. That was really informative, and it was nice to end on a slightly hopeful note. If I can ask all the panelists just to come on the screen, I'm going to address some questions to each one of you, and I'll begin by going down the line. So I'm going to start off with Mike, then I'll go to Victor, and then I'll go to the speaker. So with Mike, one of my favorite things about insurance, and that people don't realize, is it incentivizes good behavior, right? So when I don't smoke, my insurance, my life insurance premiums go down. In fact, if I go to the gym, sometimes your health insurance premiums go down, right? So they really want all of us to be better. And one of the things that we seem, Victor presented this kind of like doom loop scenario where we're spiraling down, but the other way is to spiral up, right? And what we're trying to do is, it sounds like to me, if I could summarize you gentlemen, is we're trying to all come together using the government, using our insurance agency, and to halt this spiral down and then figure out a way to spiral up. And it's a hard problem because this is a collective action issue. It's slightly different than and that's why it's a little different from single family owned homes, right? But paint us a scenario about what we need to do to be make Hawaii a more insurable market.
Well, that's kind of a very big question, Seth. So specifically for condo, speaker actually hit it on the head. If insurance is this collective pool of money. So all the premiums for unit owners coverage, and I use that instead of HO6 because State Farm doesn't call theirs an HO6 and they write a big chunk of the market. So whether the building is really healthy, they've got good reserves, their pipes are maintained, or not, everyone is paying more. But the buildings that have the well-maintained units where the unit owners are checking under their bathroom sinks, their kitchen sinks, around their toilets, their washer dryers, their refrigerators, they over time will pay less than those buildings that have not fixed their pipes and have not updated everything. So the first step is for the unit owners to take care of their own units. The next step, which is the big expensive one that Victor was alluding to and creating what looked like a doom loop, is doing the piping repairs where they're necessary, certainly for older buildings, or at least do an inspection to proactively understand what needs to be done. So then that building can pay relatively lower premiums than others in the market. The hurricane piece is just a little bit trickier because of the reliance upon reinsurance. And there's a couple of things. One is it's going to take some time. So you do need the Hawaii Hurricane Relief Fund to serve as a market of last resort. Coverage is available, but it's expensive because it's coming from these non-Hawaii licensed companies called surplus lines. So having HHRF available is a good step. The other thing, quite frankly, and I've shared this with Victor, is somebody needs to lobby Fannie Mae and Freddie Mac. That to what extent is the requirement of full coverage valid for different types of buildings? Because there are all sorts of different types of condominium buildings. There are 4-story frame walk-ups, and there are 40-story brand new hurricane-resistant glass and steel structures. The industry, not from Hawaii, from the National Association of Mutual Insurance Companies, did send a letter to Freddie and Fannie regarding a full coverage requirement for single family homes, and Fannie and Freddie actually has taken some action on that. So to me, that would be a great turning point to at least give us some relief in Hawaii and really around the country. This is not only a Hawaii issue.
Okay, so two questions there. One is lobbying Fannie and Freddie. Is that going to the Congress, or is that actually? I know they're semi-private public firms. Is that actually just sending a letter to a private agency and trying to get your bank, like a bankish organization, to change their outlook on things?
So we, Mortgage Bankers Association of Hawaii, have reached out to both of them and said, here's the situation in Hawaii with the hurricane insurance shortfall. It's not under control of the lenders. It's not under control of the condo buildings necessarily. It's a market situation. And they have said, we're not changing our guidelines. In fact, what they did in February is they doubled down and they came out with new guidelines that saying, as a lender or servicer, you have these loans in your portfolio, you're mandated now to validate the not just on condo loans, but on single family detached, that the replacement cost that you're insuring for is still valid. So they want us to go through extra hoops to validate every year. And so they're doubling down. So but again, Mike is right. It's not just in Hawaii, it's a federal level, it's multiple states. I've heard that hurricane insurance in Florida now, they're doing the same thing with the sublimits, just limiting it to $10 million coverage. So this problem just doesn't affect the state of Hawaii, but it's got to be at the national level lobbying done, I believe. FHFA is their regulator, and we can try and involve our, federal, state, our federal Senate and representatives, the congressional delegation that we have. But that doesn't mean we're going to get very far. So there's a safety soundness concern that they have to protect their bond holders, everybody that bought mortgage-backed securities, et cetera. So it's a trade-off.
Great. And then I have one more question for Mike. So, it sounds like you have at least for the hurricane insurance, right? You have licensed insurers, and then you have the out-of-state, and the out-of-state are the really expensive guys.
Right.
So it seems that one potential solution is to get more insurers to come into our market. So what is keeping more insurers I believe, correct me if I'm wrong, I believe insurance are actually exiting the market, not entering the market, right? And so can you describe that dynamic? And then what would it take to, or what's keeping people from coming in, and what would it take to get more people in?
Yeah, that's another great question, Seth. So historically, as I mentioned, there were three companies primarily writing condo building coverage. The premiums or the rates were considered very low. That's why there were only three companies writing them. Those three companies were competing like crazy to write that sector. Then as losses mounted, they started pulling out. Now, the problem is that when the rates are that low, if you're a big national insurance company and you're looking to enter the market in Hawaii and you're like, whoa, these rates are way too low. There's no way we can make money. We're not going to enter the market. Even if you're another local insurance company, you're going to make that same decision because you don't think you can make money at those rates. So now that premiums are going up, we have the other problem of buildings needing to be repaired. So now if you're, and I don't want to speak for them, Travelers Insurance on the mainland, and you're looking at Hawaii, you're like, okay, I can get more rate, but I got a whole bunch of buildings with water problems and old pipes that need to get repaired. And I would disagree with Victor that that is not an insurance problem. That's a condo management problem and a governance problem. And Victor spoke to that in terms of the AOAO board making decisions about buying coverage or funding reserves and all of that. So buildings have to get well, for lack of a better phrase. And some time has to go by where the loss experience flattens out and gets a little bit better. Then I think we'll have some market entrants at least, dip their toes in the water and say, well, let me write a building in Hawaii and see what it's like. This building just repiped, so I'm willing to take a shot at it because I at least know that they've made a significant effort to make their building healthier.
Interesting. Okay, so Victor, I have a couple questions for you. So first of all, as a condo owner and living in a condo building, I always get nervous about other people, right? Because I don't know, you've been on condo, I've been in condo buildings, and like it's like being in a collectivist society sometimes, and you have to worry about what other people are doing, right? And so I'm very fortunate that I can pay a plumber to come in and take care of my pipes, but there are people who just can't afford it, and I don't blame them, but because I've senior people, they dig their hand in the sand and they don't and they don't make the investment and they just ignore the problem, right? So when you say like that there's certain insurance programs where they're trying to get everybody to buy insurance, like your individual insurance, how would that even work? Because like does the condo board have the authority to, and even the ability to monitor every single condo owner to make sure that they have that? Because the problem I see, and with all this not 100%, right, is what we saw, at least I've read it a couple times on Lanai, they weren't 100% insured. So like when your building gets wiped out and you only have 75% reserves, who's going to pay the extra 25%? Especially to people who've undergone a catastrophe. Most people don't have that money, and collectively, maybe 50% do, but the other 25% don't, right? Or the other, how much? So can you talk about like, this is one of the problems is all this, the responsibility is so diffuse and people are pushing it over, and I don't even know who's doing what. So talk me through, one, is it really okay to not be 100% insured because of the Lahaina fires? It just seems like you need to be 100% insured. And then does it make sense pushing responsibility down to the individual owners if you don't have, if you can't ensure compliance?
That's a lot there. So let me try and answer that as best I can. So the way that a lot of the associations do it, and the one that I still have a unit in, and they say, okay, to make our insurance more affordable for the project, the association, we're going to increase our deductibles. So it's a cheaper premium for the master insurance. But they say, okay, we're going to increase our deductible, but what we're going to do is we're going to send a letter to every unit owner saying you have to increase your unit owner's policy, or HO6, it might be called that. And we're going to police it by saying you must submit to us a copy of your HO6 policy to make sure that you have a amount of coverage to match our deductible amount, so that, you know, if our deductible is 100,000, you've got coverage up to the 100,000. So the thing is I don't know how successful they are in monitoring it. And then what if someone refuses to get it? Are they going to go to the stage of actually fining that individual unit owner? And if they don't, fining and then foreclosing upon that unit owner because they just outright refuse. So it's difficult because you've got human nature resistant to these kinds of things. And you have 300 people and 300 people and 300 units might not cooperate. So to the extent that they police it, and what if someone cancels, they get their insurance and they send you a certificate saying I have 100,000. And then 2 months later, they say, I don't want to keep paying for this, and they cancel it. Is that management company or the board tracking to make sure that nobody cancels their insurance? So there's a lot of moving parts when they try and push it down to the individual unit owner. So I'm not sure if I'm answering your question about that. The thing I do want to say, kind of, this is off tangent, maybe it answers your other question. Going back to what you were asking, Mike, you know, human nature, lack of reserves, deferred maintenance, all of that, you know, spiral, doom spiral. I think that what we need to look at is right now, the Hawaii law, it was revised back in 2023, requires that the condo associations only fund 50% of their estimated reserves according to the reserve study. To me, that's too low. I think that in the long run, what we need to do is mandate to condo projects that they fund more of what they need, so that they have reserves when they need to fix things, they don't keep deferring the maintenance. It's going to be a long run solution to say you must fund at least 80% of your reserve according to your reserve study, not 50 or 90% or whatever percent. That's got to come from the legislation. It's going to be painful for all these condo projects to get their reserves up. It's going to be a long run solution, but in the long run, I think that's what we need to do. And the associations won't do it. It's got to be mandated. I'm convinced that they have to do that.
Oh, great. Thank you so much. So that's a good segue to the speaker. So one speaker is the idea of increasing the amount of reserve requirement. Was that suggested in any of the legislation that was being considered? And is that something that is possible with the legislature going forward? So that's the first question for you. And the second is, you know, one of the things we want to avoid is transferring a bunch of private risks to the public sector balance sheet, right, to taxpayers. And so anytime that there's a special fund for insurance or to help people pay for deferred maintenance, one thing we got to worry about is, are we putting the taxpayers on the hook for other people's behavior, right? So my second question is to you, what are the safeguards or the governance mechanisms in these funds to ensure that the taxpayer is not on the hook for, you know, just the general risk of climate change, which we have to come to terms with?
Okay, Seth, so for the first question on the reserve requirement, you know, state law does currently require that buildings be insured the condos be insured at 100%. So there is a general requirement there. On the reserve issue, our working group did not address that when we drafted House Bill 2686. It's fair to say that that's probably going to be discussed with the governor's working group this summer on whether or not to increase that reserve requirement. It does lead to the second question that you asked about the role of government when it comes to condo governance. Condominiums are set up to be self-governed. It's a self-governance. I think our goal is to really not involve government when it comes to the management and operation of condo buildings. We want to have the owners, the association members, be responsible for that. But it is important for government, and especially in a situation like this, to provide some kind of infrastructure or some kind of capacity for or incentive for condo buildings to work through these problems. And that's where, you know, the CPACE, for example, comes into play. We want to provide an easier way for buildings to finance their repairs so that they can mitigate risk and be insurable. The CPACE, I didn't mention this earlier, but the CPACE program was the proposal was to fund it at $20 million, but that was set up as a loan, so that amount would have to be repaid through the premiums that are paid into the fund through the condo association. So it was always set up to be a loan. It was not meant to be a taxpayer subsidy that wasn't going to be collected. So I think it's really important for whatever solutions we look at, that we make sure that that there are incentives in place for condo buildings to become insurable, to mitigate risk. And the other thing I wanted to mention was that when we started this in November, condo buildings were at issue, but now from what I'm hearing through the insurance commissioner's office is that townhomes are now being are affected by property insurance. There's an insurance company that is not renewing policies for townhouses.
Wow. Well, we covered a lot, and I think we went really quickly, and we're running out of time. So I apologize to all the audience members that posed a question, but we're not going to be able to get to them. We have 5 minutes left, and I would like to just go through one more time through all three of our panels. And if there's something that you haven't, each one of our panelists, to give you the last words, say something that, if there's something you haven't addressed yet, something that you hope that Hawaii needs to consider, just final parting words for us, or things that we can work on ourselves going forward. So let's start with you, Mike.
Well, you know, I think I mentioned it before, you know, this is a tough situation, but I'll say this: we dealt with it after Hurricane Iniki as well. This is not the first time Hawaii has dealt with this combination of reinsurance issues and insurability issues. It was 30 years ago, so many of us have forgotten. Sadly, I was here in Hawaii practicing in the insurance industry, so that just tells you how old I am. But it will get better, but it's going to take time. And we also have to understand that with climate change risks, premiums are not going to go back to what they were 3 or 4 years ago. There are significant risks that are getting different every day. And we just have to protect ourselves as much as we can. So that's taking care of our own units, making our homes resilient. All of those sorts of things are kind of best defense, both from climate change as well as to make our insurance premiums as low as they can be.
Victor?
I did answer 3 questions in the answer box. I typed them up. Those are relatively easy questions that I could take up. A lot of those were questions that are better answered by Mike. My only final thought is that getting back to Speaker Psyche, what he was explaining about the insurance stabilization bills that were proposed, there's no perfect solution, but I think there were really good solutions. I was sorry to hear that they did not go through. We were supporting that bill, one version or the other. They were, and so we need to try and get those resubmitted in the next cycle and better support at the grassroots level. And you need to communicate everybody on the call to their legislators, their representatives, to help support those bills and move them along if it goes through, if they get presented next cycle. So that's my last words of wisdom.
Speaker?
So I would just say a couple of things very briefly. One is to remember that we are not alone. Hawaii is not alone. This property insurance issue is a national issue. I mean, if you just Google this, there's so much media nationally on property insurance impact throughout all of the states. The second thought is, you know, mitigate risk. We need to just mitigate risk in our state. As you know, there's so many there are wildfire zones. There's so many natural disaster risk in our state, and we need to just do everything that we can to mitigate risk.
Well, guys, I really appreciate all of the insights and everything. One of the takeaways is I think that we all have to come to terms as a society that the cost of owning structures is going up, right? Because the risk of that is going up. And one of the things we're doing here is we are trying to help with that transition to make sure there's not high levels of volatility and problems, but it's just going to cost more to own a home if there's more risk everywhere, right? But we can handle it, right? We're a very rich society. We're lucky that we are a rich society and not a developing country where this is an even bigger problem, right? So again, thank you so much for all of your insights, everybody. This is a recorded presentation. So to all the audience members who have been inquiring about this, please, you will get a link with a YouTube clip for this whole entire presentation. If you liked what you saw, please come to our next events in the future. And if you have any other ideas on what we can discuss and bring together and help to inform you as the public, we always appreciate those as well. So mahalo, everybody, and have a great day.